Hey there traders, how are we all? Long time no see. I think this is my first video for 2020, so hello. Um, I wanted to quickly share with you guys um, a very simple trading technique. It is part of stuff that I've taught you before, um, but I want to simplify it further. I just got off the phone with one of you guys who who says that their pet peeve when it comes to trading is doing the analysis. They absolutely hate it. They love the concept of trading, but they don't really want to analyze too much. And so, could I teach them a simple technique that I use personally to make money off the charts? Now, yes, it does help for you to become as familiar as you possibly can with market movements. But here's one that I did earlier, right? So here is pound USD pair on a 15-minute chart. I took this trade here, right there, right? Bounce off the EMA 50. It's an engulfing candle at the yellow line. Let me zoom in a little bit. So at the yellow line, and I rode it till the top of this mark here, right? Yes, it's a non-Asian currency pair, but the setup was there, right? And so without paying too much attention to whatever the hell else the market's doing towards the left, like beyond where my screen is, and without doing a top-down analysis, here's the basic crux of this movement. So all of you that follow my way of trading, you're familiar with how I like the interaction of price and our EMAs, primarily the 200 and the 50. Now, you guys are probably looking at my screen and saying, you see more than just two EMAs on there. The yellow one, for those of you that are familiar, that's the EMA 18. I use that primarily just for trading pullbacks, right? So if I'm expecting, if say for instance this candle is 15 pips long, then what I might do is I would wait for price to open on the next candle and then come down, hit my yellow line, the EMA 18, and that would be my pullback entry, right? Another way I could probably do that is just jump onto a 5-minute chart and then just look to see when price does come down, is it interacting with the body of another candle that's just to the left of that. If it is, I'll take an entry there. This, let's call it a green line. This green line here is the EMA 100, right? I use this primarily for stocks, but I've recently started to use this for forex as well. And the reason behind this is I'm starting to get more lazy with my trading, right? So I don't want to be doing a crap load of analysis. Especially when I'm writing all these articles and busy with other stuff. I don't want to be doing my analysis. So instead of using fibs and the like, I'd probably just put my EMA 100 up. And I know that when price is doing something between the 50 and the 200, especially around the 100, then chances are on a fib tool that's somewhere between the 382 and 618. Right? That's what I would expect. And if it then is giving me some sort of structure there or some sort of movement off the 100, like it did here, where it just bounced off the 100, went up this way, even if I can't make sense of any of this, screw it. But what I can make sense of is when it does do its move and then it starts to create skid marks on my charts. It's just going up, down, up, down, up, down without really going anywhere. That usually is a almost like a certain sign that the market's going to eventually hit something, which is in this case a support area, and then continue going up. That's what I'm looking and that's what I'm expecting. So for those of you that don't like doing an analysis, if you could just look at this and perfect this, just your bounces off your EMAs, you'll make money with it, right? And in this regard, I don't mean where anytime you see like this and you just take it. I mean to say where there's got to be somewhat of a structure. It's similar to Elliott wave structure, and I know two people immediately as soon as I say Elliott wave structure, they're going to say, "Oh crap, I don't understand this." I know you know who I'm talking about, but many of you are also not very happy with Elliott wave structure. But in the interim, like what I'm looking for is just some sort of move where prices bounced off the EMA, gone up or down, created somewhat of a trend, and then just it hit a stop and then just went sideways. Right, sideways. This is even better where it's going sideways, but in a way going down as well. Right, so it's coming heading towards one of our EMAs. Now, once it gets to our EMAs, here's a couple of things that we really want to be familiar with. One is that which EMA is it at? Because again, like there have been times when, especially during this pandemic, where I've absolutely hated trading off the EMA 50. So I'd look at the 50 and I'd say, yeah, not good enough for me. But in this case, look at which EMA it's coming towards and the interaction that it has with the EMA. So let me put it this way. When you're looking at price around an EMA, there's pretty much three sorts of setups that could happen around there. One is where price actually sits above the EMA, not quite touching it, right? Actually, four setups. So that's the first one where it's not quite touching it. The second one is where it does touch it and then bounce off, right? So in this case where it's right on the EMA without the body being too outside of it. And we've got a wick to the low on here as well, so there's been some interaction and then it's bounced off. The third one is where price is right on the EMA. So you've got, in this case, a red candle with a green candle sitting right on top of it. And the fourth one is when it's below the EMA. Right, so again, first one not quite touching, second one touching, third one right on top of it, and the fourth one below it. Right? Forget about what sort of that candlestick structure. It could be an engulfing, could be a morning star pattern. Doesn't really matter at this stage. But that's what could happen on there. It's up to you to select which one you prefer to trade with. Like I've got my favorites. My two favorites out of this is the one that's right on top of the EMA, this one here, and this one where it's kind of really interacting with the EMA. These two, I don't like so much, right? This one normally tends to, for me, stock-wise, tends to happen at the EMA 100. And so I prefer trading that off the 100. Also, for those of you that trade indices, the 100 is beautiful for indices, especially when it's giving you an engulfing straight on top of the EMA like this, right? Especially off the EMA 100, love them, right, for indices. And I do that for stocks as well. So select one of these or two of these that you really like because, see, in this case, where it's kind of just above it, this is close enough, you could say, and price broke out. The other two things that you really want to be paying attention to here is, besides the sideways movement, is that when market or price breaks through a support and resistance, like we've got here, it's going to do two things. And not just this, also the EMA is going to do two things. One is it's going to retest that in the next candle. And two, it doesn't always do the second one, but chances are it will do a structural retest, which means not just one candle, but multiple candles. How we draw our line will, to some extent, give us an indication of whether it's breaking down and going to continue going down, or it's going to do some sort of a continuation pattern, bouncing off our EMA or bouncing off the line and then continue going up. So familiarize yourself with that. But in short, if you could just look at where prices come from, and if it's done a bit of a trend run, and then whatever structure it's creating in the interim, like skid marks, sideways movement towards an EMA, then the third thing that you really just have to perfect is choose one of these. Choose one of these structures above, below, on, or at the EMA, and recognize the candlestick structure. Morning star, evening star, engulfing, tweezer tops and bottoms. those are the most common that tend to happen. In particular, the most common ones would be Morning Star, Evening Star, and engulfing. When you see that, it's also a nice um, tight setup where your stop loss isn't massive. For me, it was just below here. I didn't really care how many pips that was, but it was just below here. It becomes a really easy trade. You don't have to overanalyze. You don't really have to. I didn't even bother checking to see if there was any news, right? And if you look, they're everywhere. If this is the only thing you could master, done. Like for example here, we could forget about this structure. We just know prices come from the 200. Okay, it tried to do its bounce off here. It's probably New York session or whatever it is. I don't know at this stage, but maybe the beginning of New York. But for me, it was outside of this structure. Forget about this sort of stuff. Remember, never go from a lower EMA to a higher EMA because this is the sort of stuff that can happen. A lot of traders would get caught up here, would get caught up here because, hey, market's shorting, right? For me, I wouldn't care. And here's another example of where you would choose to see what type of bounce off the EMAs are important to you. Where this one's just touching it and this one's on top of it, right? You could put some, establish some rules around this where this has to be a nice engulfing, where this would have to be at least here, and that you're going to have to take note of where your stop losses could be as well. But this was a nice trade there yesterday as well. So it bounces off of this. I missed this. I drew these lines in, but I completely missed this. But once you see this off the 100, same things tend to happen off the 200 as well. And then remember when price makes its way back to the 50. In this case, there's no interaction with our 200 here, so we kind of avoided that trade. If you want to be a cocky trader, you can take these because this is somewhat of a continuation pattern, right? But if you want to be a consistent trader, you're going to have to pick and choose, right? That's how I trade. I pick and choose almost all of the time. The setup has to be where I'm always playing hard to get with the market, right? So this isn't good enough. It didn't touch my EMA 50, but when it does touch it, I wanted to touch it in a nice way, so that for me it's like, okay, I'm going to put some money down. I'm going to risk some money on this, and then the market goes forth, right? So that's the simplest thing. Quick recap of that is one, you want to be able to say, yes, there's been some sort of a trend or a movement that's happened, and you can so easily tell by just the way that the EMAs are positioned. You want it to be 200, 100, 50. You want to see some bounce off the 50 or the 200 that then resulted in somewhat of like a trend run, and then followed by where market just kind of goes sideways, skid marks, right? And then the last thing is for you to master the interaction of the market price with your EMA, the selected EMA, whether it's the 50, the 100, or the 200, where once it's interacted with it and then given you a candlestick pattern that you recognize, right? If you can do just that, you don't really have to bother too much else about analysis. You will make money with this, okay? When it comes to Forex, in my opinion, it's very difficult for people not to make money from this. You will certainly make money from it. You will lose money though if you are constantly just kind of jumping into every um, entry that would seem like a setup. Okay, and again, here's the fourth, I think, type of structure that you probably want to look at, where it's below the EMA. It's not at or on or above. It's below it, and you decide if you really want to be taking this. With the JPY pairs, you do want to look at to see what the majors are doing and correlate with the other currency pairs. Look at this, Euro JPY. I didn't take this one. I didn't see this one. But this is right on top of our EMA 50. So in this case, the beautiful part about these boxes is that if I was to take an entry there, we're only about 3 pips or 4 pips away from our 50, and below it's only 8. So even if I dropped my stop loss at the 100, I'm still at a stop loss at less than 20 pips. Right. So in this case, market moved, and look at that, it's 42 pips. Just quickly before I sign off, so there's two ways of trading the market, right? Like two easy ways of doing it. And one is where if you see a setup and a structure of, say, the 200 or the 100, a nice one, you take your entry and then you could trail your stops, right? Or where you're bringing the stop loss up to, say, break even or break even plus a few pips, and then just let it be, let the market run. Or the other thing you're doing is where you're seeing something market hasn't been doing really well, and you could just scalp it, right? With scalping, if you can get in and get in 10 15 pips, yes, that's outside of what I'm saying. For new traders, take the 20 pips and be content with that. You could do 10 15 pips at a time, and walk away there if the market's really not doing its thing, or it's really ranging. Do so, but still follow the rules that we've got, where your entry is at our EMAs, right? If the market is kind of bouncing up and down, you want your entries to be at the EMAs. At, if you're going long, you want to be at the low part. If you're going short, you want it to be at the high part. And the reason behind it is that the bounces off the EMAs are like it's like a trampoline. Chances are, if you're just kind of jumping off the ground, you're not going to catch as much momentum to be able to bang 10 or 15 pips. If you're doing it off a trampoline, yeah, chances are you probably easily get 10 or 15 pips before you realize, hey, I messed up, or the market's kind of just doing its own thing. It's not really following what my rules are for this moment, or I've not recognized market movement accurately enough, right? So you'll still make some money and then get the hell out of there. The very last thing I want to say is it's a reminder to all of you traders out there, because too many of you are trying to chase massive amounts of pips, like 100, 200, 300 pips every single week. And you probably are seeing groups or other traders out there creating videos that are saying, hey, I made 300 pips. Yeah, but they're probably not doing 5 or 10 lots. They're not doing this consistently enough. Remember, for you, if you could so easily just bank 30 to 50 pips every single week, just following the rules that I'm saying, then you just increase the number of lots that you're putting onto that eventually as your account size grows. And that's it. You'll be consistent. How much money do you want to make? Do you want to make £1,000, 2,000, 3,000, 5,000 pounds for the week? £5,000 for the week with pound USD might be 50 pips, right? At 10 lots. Eventually, if you could train yourself right now just to be able to take or bank 50 pips every single week, at, say, a mini lot or a micro lot, and you could do that for the next 3 months, you've nailed your ability to be able to pick the setups, the simple ones, and go do three, maybe 15 to 20 pip trades. That's all it would take to hit 45 to 50 pips, right? If you're more confident with your setups, you could probably do 3 by 20 pip trades. And in that, it's enough. I've been very lazy with my trading because I've been doing so many other things. But there are times when I'll just come in and I'll just do 150 pip trade for the week and I'm done. That's all you're aiming for. You're not aiming to be super rich. You can make a lot of money through this, but remember, treat this like a business. All right, guys. So I just want to finish off with saying thank you to all of you that have reached out to see if I'm still alive, because I've been so quiet. I've just been busy with stuff. All the best. Please try and just do these trades. Just look for these, wait for these trades to come, and you'd be successful. You realize how easy this can actually be. Okay? All right, guys. All the best. Bye.